All right, let's get right into it. Goodyear just dropped its third quarter financial results for 2025. And frankly, there are some huge numbers making the rounds. So, in this explainer, we're going to slice through all the corporate jargon and really break down what these results mean for you, the independent tire dealer. So, this is the number that's grabbing all the headlines, a reported net loss of $2.2 billion for just the third quarter. I mean, that is a massive figure. And yeah, on the surface, it looks pretty bad. But you know as well as I do, one number rarely tells the whole story. So the real question is, what is actually behind that loss? Is it a true reflection of how the company is performing day to day? Let's find out. To answer that, we've got to get behind that big headline number and dig into the details of Goodyear's bottom line. And this is where things get interesting. It's really a tale of two completely different numbers. On one hand, you have that reported loss of $2.2 billion. But then, Goodyear also reported something called an adjusted net income, and that was a positive $82 million. So how on earth do you get from a profit to a loss that gigantic? Well, the answer comes down to these things called non-cash charges. Basically, they're accounting moves. They hit the official profit number, but it's not like actual cash is leaving the company's bank account. And the source material points to two enormous ones this quarter: a $1.4 billion tax allowance and a $674 million goodwill impairment. And knowing that helps make sense of the company's official take. Goodyear's CEO, Mark Stewart, says the company actually delivered a meaningful increase in operating income compared to Q2. He's framing this as proof that their big strategic plan is actually working. Okay, so now let's zoom out a bit and take a look at the global snapshot. See how Goodyear is actually performing in different parts of the world. So here in the Americas, things are a little bit of a mixed bag. Net sales are down and overall tire volume is down. Now for you dealers, this is the key number. Replacement volume dropped 8.1%. Goodyear's report blames this on high inventories of imported tires that are still clogging up the U.S. distribution channels. But on the flip side, OE volume, that's tires sold directly to car makers, was actually up over 4%. And we see a pretty similar story over in Europe, the Middle East, and Africa. The replacement market was down again, about 8.6%. But just look at that OE volume, a huge jump of almost 19%. And that really strong performance in OE helped push net sales for the whole region up more than 4%. Now, over in the Asia-Pacific region, that nearly 19% drop in sales might set off some alarm bells. But there's a really important piece of context here. This drop is mostly because Goodyear sold off its off-the-road or OTR tire business. So we're not really comparing apples to apples with last year's numbers. So when you put it all together visually like this, it becomes crystal clear where the bulk of the company's operating income is coming from. The Americas is the undisputed workhorse here, bringing in $206 million, which is way more than the other two regions put together. So given that whole global picture, what's Goodyear's strategy to move ahead? Well, that brings us to their big transformation plan, the one they're calling Goodyear Forward. According to the company, this whole plan rests on three main pillars. First, just massive cost savings across the board. Second, restructuring their whole portfolio of businesses. And third, using the cash from that restructuring to pay down corporate debt. And Goodyear is reporting that this plan is already making a real financial difference. They state that it delivered $185 million in benefits just in this third quarter alone. So a huge part of that second pillar, the portfolio restructuring, has been selling off some major assets. We're talking about their chemical business, that OTR tire business we mentioned a minute ago, and the Dunlop brand. All told, the money they brought in from just those three deals adds up to roughly $2.2 billion. And that, of course, leads us right to that third pillar. Goodyear says this cash is going straight toward paying down its debt, which is all about shoring up their financial position for the long haul. Okay, we've covered the big headline loss. We've looked at the regional performance, and we've walked through the corporate strategy. So let's bring it all home. What are the key takeaways from all of this for you, an independent tire dealer? So here's the bottom line. The market is basically being pulled in two different directions. The challenges are pretty clear. The replacement demand is still soft, and like Goodyear's own report says, there's a ton of imported tire inventory still floating around in the US. But at the same time, you've got these stabilizing factors, like Goodyear gaining ground in the OU market and all those cost cuts from their forward plan, which are supposed to help improve their margins. And this really leaves us with the big central question, doesn't it? Goodyear has definitely streamlined its business. It has a clear plan to cut costs and slash its debt. But can that internal strategy move fast enough to beat the challenges of a really uncertain replacement market? That right there is the key variable as we head into the final quarter and start looking toward 2026.